If IPO talk has ever sounded like a wall of numbers, you are not the problem. Most explanations start in the middle. So let us begin, after closing time in Maya's pizza shop. The first shop works, and now she dreams of one central kitchen and several neighborhood locations. That dream could serve more families, but Maya needs money before those new shops can earn any. She could save longer, borrow, invite a private owner, or ask the public to become co-owners. That last door is an IPO. It is not a company magically appearing inside a stock app. It is a company saying, "We want to grow, and we are willing to share ownership to help pay for it." We will walk through that door with Maya, one simple step at a time. By the end, you will know where the money goes and why one share can have one price before the market opens and another afterward. Before Maya chooses, she asks a simple question. What am I getting, and what am I giving up? A loan lets her keep the ownership, but the loan must be repaid. New owners can provide money without a loan payment schedule, but Maya must share part of the company's future. Public owners also expect honest information, regular updates, and responsible leadership. So an IPO is not a trophy, and it is not the automatic next step for every successful company. It is a trade-off. Maya would choose it only if access to a much larger group of owners is worth the cost and responsibility. Here is the picture to keep in your mind. Maya is not selling pizzas. She is offering small pieces of the business itself. Maya needs a team before she can invite strangers to own part of the business. Company leaders define the plan. Lawyers help prepare the public explanation. Independent auditors check the financial statements. Banks help plan the sale and ask whether investors are interested. Think of Maya opening the kitchen, the records, and the growth plan for inspection before inviting future owners inside. People ask, how does this business make money? What will the new money pay for? What could go wrong? Their job is not to cheer for Maya. This may sound like many different roles, but they share one purpose: turn Maya's dream into facts that future owners can examine. Those answers go into a document called a prospectus. Think of it as the company's public information and risk folder. It explains the business, its results, its important risks, who owns it, and how it plans to use the money. SEC staff reviews the filing to check that required information is disclosed. That is not a recommendation, a safety guarantee, or a promise that the stock will rise. The prospectus gives investors information. Each investor still decides what to think. When Maya shares this folder, she is not asking the government to call her company a good investment. She is giving future owners a clearer view of what they may be choosing. Now ask, who is selling the share? If Maya's company creates a new share, the buyer's money goes to the company. That is a primary share. Maya keeps her old shares, but because there are now more shares, her percentage of the company becomes smaller. That is dilution. Her share count did not change. The total number of shares grew. Now suppose an early owner named Alex sells one of his existing shares in the offering. The buyer's money goes to Alex instead. The company did not create that share, so the company does not receive that payment. Same IPO, two possible cash destinations. Whenever the language feels complicated, ask one question. Was this a new share created by the company, or an existing share sold by an owner? Before ordinary public trading begins, the banks speak with potential investors. They ask who may be interested and roughly how many shares they might want. Think of a reservation list before a grand opening. Interest is not yet a purchase, and asking does not guarantee that anyone will receive shares. That interest helps the company and the banks agree on the offer price. The banks then decide which interested investors receive the available shares. This is called allocation. Keep the order simple. People show interest, the offer price is agreed, the offering shares are assigned, and only then does the public market open. The offer price belongs to the sale in the offering. The price that buyers and sellers choose in public trading belongs to a different moment. Now, set Maya's lesson beside a real company. When Amazon went public, the offer price was $18 a share. Amazon issued new shares in the offering we are following, so the money, after offering costs, went to the company. That is the receipt to remember: $18 a share. Whatever buyers paid later in public trading could not travel backward and change Amazon's offering receipt. Then the public market opened, and Amazon's first public transaction happened at $29.25. That did not make the $18 offer fake, and it did not mean Amazon collected the difference. Think only about the cash path. When one fan resells a concert ticket to another, the later payment goes to the fan, not back to the box office. A share is ownership, not a ticket. Only that cash path is similar. The offer happened first. The public trade happened later. Both prices are real because different people exchanged ownership at different moments. Going public does not end when the ticker appears. Maya must keep owners informed with regular reports and updates when important events happen. New results are discussed in public, and the share price can change whenever the market trades. Maya began with a simple wish: money to grow. She gained access to more owners, but she also accepted an ongoing responsibility to them. The company now lives with its windows open. Capital and responsibility arrive together. Here's the whole journey. Maya needed money to grow, so she invited the public to share ownership. Her team put the business, the plan, and the risks into a prospectus. A new share sends money to the company. An existing owner's share sends money to that owner. The offer price comes first. Public trading comes later. Quick check. Which price belonged to Amazon's offering? $18. $29.25 was the first public trade. So the later price did not become extra cash for Amazon. Follow who sold the share and you will know where the money went. In episode 3, we follow a share when you tap buy. Subscribe and turn on notifications so you know when it arrives.